through our research, we've seen that when you put financial resources in the hands of women, families benefit, communities benefit, countries benefit. So hence the focus, at least from me today, you'll hear a lot on, financial inclusion in women.
So we're here to talk about financial inclusion today, and as I pointed out before, this is a very important topic. One of the most well-cited pieces of research that's been done into this field was conducted by the World Bank. And in 2017, the World Bank found that 1.7 billion people around the world, or about 30% of adults, so a very big addressable market, remain without a transaction account. And the other thing that the World Bank research found was that financial inclusion and technology are intrinsically linked. And while we've made great strides in recent years to close this gap in markets like India and China through technology, clearly there is still a lot of work to be done. So I thought we could start the conversation today by first putting the question to the panel, how do we measure financial inclusion? And how are we closing that gap? Harsha, would you like to start?
Sure, thanks, Dan, and thanks very much for having Women's World Banking at this panel. So as you rightly mentioned, the World Bank Global Findex is the tool that measures financial inclusion. It looks at, who has a bank account, men, women, mobile money. It looks at transactions that are done, who saves, who borrows, things like that. And what we've seen is, over the last several years, this is a survey that's done in collaboration with Gallup. What we've seen in the last 2 rounds of this work is that the number of adults that have a bank account globally has increased from 62% to 69%. And the number of adults, though, who still don't have a bank account is 1.7 billion. Of that number, just under 1 billion, or about 985 million women, don't have bank accounts. So they're still outside the formal financial system. And 10% of those women are in the MENA region. When you look at the gender gap, the sad news, unfortunately, the gender gap hasn't budged. So while we saw that, there's a 9% increase in the number of adults who have a bank account, the gender gap has stayed stagnant at 7% in, 9% in the developing world. So what this says to us is that while in absolute terms, number of women that have a bank account has increased, the gender gap, has stayed the same. So there's a ton of work for us to do in this space as Women's World Banking. In MENA, interestingly enough, the gender gap is 17%. So it is the highest compared to any other region. And you can ask, why does this matter? Why are women so important? How is it of interest to financial service providers? I mean, through our research, we've seen that when you put financial resources in the hands of women, families benefit, communities benefit, countries benefit. So hence the focus, at least from me today, you'll hear a lot on, financial inclusion in women.
Gentlemen, did you want to pick up on that theme as well?
Dave? Maybe happy to. As Harsha said, there's a lot of good data that shows how many people do have accounts and how many yet don't have access. At the Bill and Melinda Gates Foundation, we certainly take those data very, very seriously and use that as kind of a benchmark for ourselves and our partners. There's other aspects of measuring progress that are related to that, and not the least of which is, in many cases, the poorest people that are the most vulnerable are also beneficiaries of payments. It could be social protection payments, it could be food subsidies, and these sorts of things. And we look at how quickly, whether it's governments or non-government organizations, are digitizing those payments. And on the surface, for those of you in the audience that think, well, direct deposit of wages has been done for a long, long time, and yet these social protection payments aren't digitized. And the way that connects with what Harsha was just talking about is, in many cases, the beneficiaries of these payments are women. And in many cases, these are essential subsistence kind of payments. So if it doesn't get to them, that's a very bad outcome. And if the full amount doesn't get to them, that's a very, very bad outcome. So digitizing these payments can in fact be one of the catalytic reasons that people go from being unbanked to having a transaction account. So that's another way to look at it. And the same is true for micro and small enterprises. When you look at how these enterprises are formed and then how they grow, in many cases, they're also affecting the same population. And these are often led by women. And the same thing that Harsha talked about in terms of closing that gender gap, you can make a lot of progress by helping these organizations become financially included as well.
I found a great quote actually by Melinda Gates, and I wanted to share it with you. Melinda Gates said, "When the government deposits social welfare payments or other subsidies directly into women's digital bank accounts, the impact is amazing. Women gain decision-making power in their homes with more financial tools at their disposal. They invest in their family's prosperity, and they help drive broad economic growth." So clearly there's a big translation there, but David, to bring you into the conversation as well, what would you say are some of those key barriers to financial inclusion today, and how has that changed over the past few years?
Well, thank you very much. Before I start, as many of you know, we lost 19 UN staff in the crash in Ethiopia. So I just wanted to say, all over the world, flags of UN officers are flying at half-mast today. Coming back to the question of this measurement, and in a way, this are you banked or are you not banked is not, there is no black and white answer to that. And there are lots of details and qualitative elements as well. Before the panel started, we were just talking, is that, you know, if you have a low-end smartphone, you may be banked electronically, but your smartphone actually may be exposing you to fraud and loss of your data and all kinds of other issues. I think when we look at this question, we tend to think about what is the role of financial inclusion within a broader set of empowerment and enabling factors. Certainly, we absolutely agree with the core thesis of Melinda Gates, which is that, you know, with cash transfers, social protection floor, and so forth, putting money into the hands of women decision makers and household leaders is absolutely one of the best ways to protect children and allow them to survive and thrive, which is our core mission. We are very mindful now of not just the gender gap, but also the age demographic gap. And I've been struck today listening to many speakers talking about the demographic shifts, particularly in this region. So right now we have 1.8 billion young people between 10 and 25. And I don't have data, and perhaps Harsha does, about how the banking dynamic works, whether you're young, but I'd wager that they are significantly overrepresented amongst the unbanked. And this is going to be the largest ever cohort of young people. It's the largest in history, but given the demographics, it will be the largest ever group of young human people. And everything, development, peace, security, climate change, comes down to this cohort of young people who by 2030 we want to have in good training jobs. And yes, banking and access to finance is absolutely one critical enabler. But I think the question for us is, well, if you have now where we have 60% of 14 to 16-year-olds, if 60% of them are functionally illiterate and functionally innumerate, then even, you know, access to new tools and financing is not really going to enable them to transform their lives. So I think we tend to look at financial inclusion as one key pillar of a whole lifestyle thing, which actually even begins in early childhood development, critical moment 0 to 5, when all the neurons in your brain are linking up together. And we have a kind of framework where we talk about kind of citizen development, moral development, financial development, and livelihood development as three kind of pillars which go even from 0 to 5 in terms of teaching people about price. I'm sorry, I forgot your question, but that's kind of the lens that we would see the financial inclusion question through.
So empowering young people, obviously a key theme there. What would you say are some of the other barriers to financial inclusion? Would you like to weigh in as well, David?
Yeah, I mean, many in the audience, if you've been in the commercial banking industry for a while, you've been able to take interoperability for granted. We've had SWIFT, we've had other forms of bank-to-bank transfers, and you've realized that the value to the banking ecosystem grows as everybody has access to these platforms. So when we think about the retail space, and we think about tools like mobile money and other types of transaction accounts, how does that get accomplished? And so in the past, it used to be that if you wanted to use your mobile wallet, you had to use your mobile wallet with somebody else that had the same provider of that mobile wallet in order to transfer. And you would immediately say, well, that seems like a pretty big barrier. And so that was an example of one that we saw early on, and it was described to us as being technical, it was financial, but there was also a kind of a cultural element that whether it was new banks or microfinance institutions or mobile money providers, which are non-banks, but they're electronic money issuers, they didn't have the culture of the large banks to collaborate. And so a lot of the effort that we've put in the last 3 or 4 years is just getting these folks to convene and be able to establish this common understanding of the benefit of being able to collaborate around shared standards, shared infrastructure. And in the banking industry, you would say, we've been doing that for years. We couldn't think of any other way. But we're seeing that now interoperability is becoming just accepted, and also the value of being able to just have interoperability in markets. And we're seeing the market reaction being very, very positive.
So just on that topic, for businesses that are looking to address this issue, what is the most effective model to take down market? Is it necessarily one size fits all, or is it more of a multi-layered approach? Can you have big firms solving the problem and small firms solving the problem as well?
Is that for me?
Sure.
Yeah, I think there are actually very different models that can work in different markets. It's not a one-size-fits-all approach at all. Initially, we saw that microfinance did a lot when it came to serving low-income segments, serving low-income women. And I think microfinance institutions still have a critical role to play in certain geographies. However, we're seeing that with the digital financial inclusion innovations that have come into play, the regulatory challenges that we have seen in many markets have resulted in innovation and new models. So we're seeing mobile network operators that have come in several markets. We've seen traditional banks that have come in that are looking to serve this segment. We're seeing fintech coming into this space now, providing credit scoring models, so alternate scoring models that would allow other institutions to come in and lend to this segment. And in certain markets, we're seeing new banking models that have come into play. Just to give you an example of some of the work that we've seen, where we've seen results, we've seen a traditional commercial bank in Nigeria that served the mass market and decided that they wanted to go down market to serve low-income segments. This is the 6th largest bank in the country, had never, worked with this segment before, but was in parts of the country that had very dense populations of market vendors right outside their branches, thousands and thousands of market vendors who didn't see them as their bank, neither did this bank ever think that they would service this customer. And so we worked with them to actually mimic the informal mechanisms by which these individuals borrowed and saved. And the bank developed a product where they had agents go out and due to low KYC, tiered KYC, were able to open an account on the phone in the marketplace with 5 pieces of data. And instead of these market vendors coming into the branch, they were able to deposit with their agent. They were able to withdraw from the agent. If they needed to, they could go into the bank branch. They had, ATM cards. but they actually preferred to use the agent that came into the market. Through this process, the bank was able to acquire over 600,000 new customers. They started out with the savings product, so they didn't make money off this product at the beginning, but the whole goal was to then ensure that they could provide other services to this customer, so credit, insurance, and a whole slew of other products that the bank was able to offer. So while their acquisition strategy was coming in through savings, the idea was that, they were able to provide a full suite of services and bank this individual. And when you talk about youth banking, David, for the youth populations, this was one way to bring the young, individuals into the system and actually develop them as lifelong valued customers. So the interesting part was, the bank had a long-term play, it had a long-term vision. They knew that if they were looking for a quick, 1-2 year return on investment, they wouldn't get it. But if they're in for the long haul, then certainly this was the right way to go. And they're still very much in the process of, working and banking with these segments.
That's really interesting. I think there is a bit of a problem in terms of banks, moving towards the base of the pyramid, or indeed any business. And sometimes what we do see is a kind of cherry picking. So it's, we'll move down, but we won't quite reach the base of the pyramid. And that really is the challenge, I would say. And I think I'll give you one example. For example, in refugee contexts, we have a lot of data which shows that in terms of loans, the financial intermediaries tend to, overprice the risk in investing in those contexts and giving people's livelihoods. And yet somehow we can't really drive in those opportunities down really to the people at the bottom. I think there is some opportunity with, I would say, with traditional financial institutions. So, for example, in Indonesia, there's this phenomenon at BMT. It's an Islamic microfinance institution, really down at grass level. And I would think if you really want to get to services and banking at the base of the pyramid, I think it's an interesting model is to do a hybrid, collaborating with some of those possibly inefficient, possibly not very technologically enabled entities, enable them to sort of leapfrog into the 21st century.
Perhaps another question for you as well, David. I was looking over some recent research by BCG, and this research paper noted the fact that there's 70% of adults in South Africa have a transaction account, they have a bank account, but it found that 1/4 of them actually go to the ATM or they go to their local bank and they withdraw all of that money every time they get paid. So there's an issue with sustainability here. So how do you ensure that it's not just financial inclusion, but financial inclusion and not just stopping at adoption? How do you ensure that it's sustainable and that you can actually continue to add layers to those financial service offerings and products like you were talking about, Harsha?
So it's a really good point. There's a couple of dynamics, Dan, to that question. One is when you look at vibrant financial markets, financial ecosystems, people make daily use of the tools. And I think it's not a surprise to anyone in the audience that when you look at the retail sector in particular, scale matters a lot. In order to get the unit costs to be in that attractive range, these tools need to be used frequently. And as you mentioned on introduction, it may be that somebody uses their account one time, which is to receive their deposit, and then they immediately go cash out. And then they use their cash business as usual, which we know has inefficiencies to it. It can be a drag on being able to save and properly have that money available in the case of an emergency. So that's not ideal. It's a step forward for the reasons that we talked about, but it's not as vibrant as we would like. And when you look at some very mature markets, we've talked a lot today about China as an example. The retail payments industry in China is so ubiquitous that Alipay and WeChat Pay are handling payments. A large volume of their payments, which is in the trillions of dollars of value, is for payments under 50 US cents. People can use this to spend 15 cents to ride a bicycle for a kilometer or to charge a cell phone for 20 minutes. When you can handle payments and do that in a way that is, if not profitable, at least not for loss on 15 cents, you have a really efficient ecosystem. And this is the kind of thing, when you think about 1.3 billion people in Africa, these kinds of volumes are possible. Even countries like Ethiopia and Nigeria, which we've talked a lot about, Egypt, and other countries, those kinds of volumes are possible. But you do need to have the ecosystem mature enough so that people can use it to purchase, which means the point of sale has to be able to accept these payments. And that's a challenge that we are continuing to work on.
Dan, if I can just add to this issue of usage that you mentioned, when you look at the Findex data, you see numbers of adults have an account. But as we've been saying, financial inclusion is not about having a bank account. It's about what you can do with that bank account to enable, empowerment and, improving your prosperity and security. And what we've seen is with the latest Findex information, actually the amount of inactivity has gone up. So even though accounts have been open, those accounts are sitting inactive, and it's about 20% with the latest data that's out. And what's it going to take then for individuals who have an account to engage in that account? Why aren't they, if they've got a bank account, they've got a mobile money account, why aren't they using it? What's preventing them from doing that? And what we're seeing is that it's not enough to just go out and understand what your clients need, research what the barriers are or what the financial dynamics are within the household. What's it really going to take to trigger behavior change? Because that's what's going to be required. And so, we've been looking at focusing on women-centric design, bringing in behavioral design, behavioral science to really understand what's preventing a woman from transacting, from engaging, and what's going to allow her, what are the triggers that need to be pulled to get her to actually engage in a way that's going to benefit her.
If anyone has any questions, please do get them in. I thought we'd try and bring in a question to you, sir, if you'd like to, just while you get ready. Perhaps while we're getting a microphone over there, what we'll do is take another question from the audience, which has come through on the system. What practices can a banker implement at his or her own level to deal with this issue of financial inclusion? Would anyone like to try and answer that?
Can you just repeat the first part of it?
What practices can a banker implement at his or her own level to deal with this issue of financial inclusion?
So I'd say the first thing is awareness of the market opportunity. There is a huge opportunity to serve the and underbanked. So understand what that opportunity is. And the segments that you're looking to serve, I would say the women's market is a big one right in front of all of us, available, ready to serve. Women are good customers. They're not worse off than men. We know that their NPLs are not worse off. We know that their mobile transactions are as much as men. We know that you can cross-sell higher amounts to women. You know that women are loyal. So, women can make good customers. I'd say that's, one thing to consider. And the other thing I'd say is in order to serve the women's market, I think you need to mirror the market internally. So investing in women as clients is important, but investing in gender diversity inside financial institutions is as important. And again, there's good data out there, not data that we've produced, but when you see women on boards and in management teams, you see that these organizations actually perform much better. Their ROE is higher, their net profit margins are higher, so it's good business.
And I just have one interesting data point. Apparently, just three exposures, just visiting an office 3 times or visiting your bank 3 times could be life-changing for a young person. We have data to show that just going to a workplace and seeing, or a bank and a financial institution, and seeing it when you're 13 has about, I think it's a 60% differential in your chances of having employment at the age of 25. And I would say, look at your people, and Harsha is talking about that, diversify, but also look at how you can create rich, meaningful careers and experiences for people within your institutions by linking them up with some of these institutions on the ground that we're talking about. And it could be a great way to develop your employees, develop your own human capital, and also, do good at the base of the pyramid by mentoring and other kinds of exchange arrangements.
And we only have a few seconds left, but very quickly, is there a question over here?
It's a very interesting topic, and I observe. You need, of course, people should have desire to have bank account. Equally, you need infrastructure. For example, person need to get to bank. Do you have a good road to commute? What hours bank has? How well trained bank representatives are? How well educated person is to use internet? And I'm talking at a very micro level in terms of if we look at the world in general. Financial inclusion can happen only if the whole ecosystem is addressed in parallel. That's my view, and I would love to hear what you think on the subject. Thank you.
Well, I absolutely agree with you. It's not one thing. It's a whole series of things about the changing attitudes within financial institutions and also educating people, children, through to adulthood, so that they can take the opportunities that come with being banked. So I think we're with you there. I think all of us would be with you there.
Mm-hmm. Yeah, I would just add really quickly, this is a very important question. And when you look at markets more broadly, and you look at how in fact do people interact with the financial system, and often, as Harsha said, oftentimes it's through an agent. Now, this is a human that is representing the financial institution or the financial service provider that they're accessing. And so the question is, how close are they? How well trained are they? And what we're finding is that if you think about markets and you think about healthcare facilities, schools, smallholder farmers, these people are all in the same community. And if you just think, I just want to pay school teachers, it's not enough. I just want to pay health workers, it's not enough. I just want to get smallholder farmers their fertilizer subsidy, it's not enough. But combined, this is the ecosystem aspect of the question. Combined, is there enough now business in that marketplace for somebody to make the investment, to make sure that those humans are there, they're well trained, they're on the job, they have the tools in their hands? It makes a big difference. So you do have to think more holistically.
Thank you very much for your question. Unfortunately, we're out of time, so we'll have to leave it there, but please do welcome our panel and thank them for being here today, and thank you for listening in. Let's get Yuri back up onto the stage now for your next panel as well. Thanks again.